I do study MBA. I may reach your level in understanding finance eventually.
Yeah.
The assignment by itself requires us to calculate Texas Roadhouse fair value and use two ways: dividend discount
Model and EBITDA.
and EBITDA. Yeah, EBITDA. I'm not gonna go too much into details to that, but maybe you will explain a couple of things that you know about Texas Roadhouse.
When I was in the US, I have seen the outlets, but I've not had the opportunity to use their services. But Texas Roadhouse is one of those simple businesses that quietly compounds over time. So they actually serve steaks, drinks, rolls, nothing flashy, but they do it consistently, well across 700 plus locations. In 2024, they brought in around 5.4 billion in revenue, and that is actually growing in double digits year over year. They're also planning 30 new stores this year. The stock trades around 29 times earnings, which is not cheap. But since it's a quality company, you have to pay a price for quality, right? So they have raised their dividends over the past few years. The long-term case is pretty solid. Texas Roadhouse runs a very disciplined, cash flow positive business with growth ahead. So if you are looking for a durable company with steady fundamentals, is worth keeping in your watch list. The current stock price is 183. But the fair value estimate is 64. And the company is overvalued based on our assumptions. So our assumptions are that the growth rate will be 10% in the future, with a terminal growth rate which is generous enough at 4%. And the discount rate is pretty high, set high, because I noticed a recent trend in the stock. So if you go to the price and look at the historical data, you can see that during the COVID crash, the stock had a pretty hard hit, like any other stock, right? But at the same time, I was looking at the dividends. One of the selling points of this stock is the growing dividends, right? But if you look at the dividend payout in 2020, they slashed the dividends by 70%. Now that's a cause for concern for me. So whenever I see companies which are slashing dividends during crisis situations, I tend to give them a higher discount rate, because the same could happen with the stock price. So if we go back to the estimation screen, let me reduce the discount rate to 10% and probably increase the growth rate to up to 14%. Now, if you change the dynamics, it is getting closer, but it's still way off from the fair value. The company has grown by double digits in the last couple of financial years. It's almost 15% plus. The cash flow is still positive. The fundamentals are good, except the market has priced it at a very high price. At this point, it's a great company for existing shareholders. And the dividend yield is not too high. If you look at the dividend yield, it's 1.41. It is very close to the market yield. So there's nothing here that screams buy for me.
Companies have two strategies of returning, giving back to shareholders: paying dividends and increasing dividends, and second, share buyback. What companies should do to make the stocks more attractive?
So the company has two options to pay back their shareholders. That's how they are adding value to their shareholders. Texas Roadhouse, as we already noticed, is paying dividends, growing dividends in the last 3 years. They've been giving 124 million, 120, 147, 162. At the same time, they are buying back their own shares. It doesn't match or grow similar to the dividends being paid. The buyback percentage has gone down because the management realizes the fact that the stock is overvalued. And probably that could be one of the reasons why you see that the dividends being paid is 162 million, but the shares being bought back is just 80 million.
Why? Why is that?
As a dividend investor, getting growing dividends looks like income for me, right? So it's separate from the stock price, and irrespective of the fluctuations of the stock market or the price of the stock, I keep getting my dividends every quarter. If the dividends are growing, that is treated as a source of income for the dividend investor. Even if the stock price crashes by 50% or 60% tomorrow, my dividends are expected to be holding at the same level or not fall as bad as the market.
Yeah.
And that's why I showed you earlier that when they cut the dividends by 70%, I was not happy because I don't expect that from a dividend paying company. They did recover and pay back more the next year. That's fine. But when it comes to share buyback, if the company price is overvalued and the company keeps buying back shares and they don't pay a dividend to the investor, it's great from a tax perspective because if you pay cash as dividend, I have to pay tax on the dividend.
Yeah.
But if you're buying back shares, I don't have to pay any tax. You just get more shares, and they are not taxed, right?
Yeah.
So it's efficient from that point of view. But if the stock market crashes, you're losing all the share buybacks that were done so far because you're prone to market fluctuations. So let's say a company doesn't pay a dividend for 20 years, and it keeps going up, and suddenly it drops to 10% or whatever, right? Because of market conditions or there's a new competitor in the field. So the investor doesn't get anything unless they sell the shares. But in terms of dividends, they get growing dividends every single year, which is actual cash in hand for the investor. So that's one argument on why dividends are actually useful.
That's a great point. Thank you, Shakti.
Thank you.
There is one remaining thing. I've heard from you the phrase, as an investor, you expect the company to follow ESG.
Environment, social, and governance framework, right? So
Yeah.
most people assume that it only talks about climate change. Climate change is just one of the factors. It also covers ethical aspects and how the employees are treated within a company, and what are the growth opportunities that the company is providing for its own employees and also the society that it is trying to serve. So we have to look at the operational efficiency of a company through the lens of ESG. And that's why I feel that if a company is adhering to ESG standards, it is trying to efficiently run its business and improve the profit margin and reduce the operational cost. So that's my thought from an investor perspective.
A little bit of information on Texas Roadhouse and what they do in terms of ESG. Cooking oil, 25,000 gallons in 2024, turned into airline fuel. Can you imagine? This is quite cool. Green restaurant pilot. Open a sustainable location with rooftop solar and eco materials. Really cool. Community support donated 34.9 million in food and funds in 2024. An eco uniform, over 1.8 million plastic bottles reused in 165,000 staff uniforms. And they started tracking scope 3 emission, covering 91% of total emission footprint. Great. But there is no net zero target. Some legal trouble facing a civil rights complaints in August 2025. It's like right now over diversity and inclusion hiring practices. And they actually have quite low ESG rating, bottom 10% of peers in impact. They're quite innovative, but not following all the guidelines.
While you were explaining, I was trying to rate these parameters as per the SDG goals, Sustainability Development Goals. So what do you think?
I really like everything you've noted. All right, let's submit.
Yep. So we have the environment score of 62, social is 54. Yeah, that's what they have to improve. And then you have a governance of around 66. So on average, this company is doing close to 60. So that's what you're seeing here. And we are trying to compare with the median score within our app. When more users start rating these companies, the median score will get better. That's the take.